Welcome to the Crypto 101 show, where we dive into the world of cryptocurrencies, Bitcoin, blockchain, and all the technology with it. Whether you're experienced or a beginner to crypto, our goal is to break down complex concepts and make it easy for you to understand the basics. From Bitcoin to altcoins, we'll cover it all in a way that's easy to digest and provide listeners with the knowledge and understanding they need to make informed decisions and better critical thought. Sit back, relax, and let's simplify your understanding of cryptocurrencies on the Crypto 101 show. Listeners' Crypto Questions Volume 4. I need to start off by saying this is not financial advice, so if you're looking for that, the show isn't for you. The content of this podcast episode is for informational purposes only. The opinions expressed here are not meant to be taken as financial investment or any other advice. This is our Listeners' Crypto Questions Volume 4 episode, with 4 new questions from listeners pertaining to crypto. Let's jump in. Question 1. Why is the SEC going after crypto? The Securities and Exchange Commission, SEC, is tasked with regulating the securities market and protecting investors in the United States. In recent years, as cryptocurrency has gained popularity and value, the SEC has taken an interest in regulating the market for digital assets. One reason the SEC is going after cryptocurrencies is to protect investors from fraud and other illegal activities. Cryptocurrency markets are largely unregulated, which makes them vulnerable to scams, Ponzi schemes, and other types of fraudulent activities. The SEC has been cracking down on initial coin offerings, ICOs, which are a type of crowdfunding using cryptocurrencies that do not comply with the securities laws. Another reason the SEC states it regulates cryptocurrency is to ensure that the market is fair and transparent to its standards and values. In traditional securities markets, companies are required to disclose important information to investors, such as financial statements, risk factors, and other material information that could affect the value of the investment. The SEC has taken a similar approach with cryptocurrencies, requiring companies that issue digital tokens to register with the agency and provide investors with important information. Overall, the SEC's actions are aimed at protecting investors and promoting fair and orderly markets, but there are many critics to this. As the cryptocurrency market continues to evolve, it is likely the SEC will continue to try to regulate the space. Question 2. What is the difference between custody and lending? Custody and lending in crypto are two different things. Custody refers to securing the private key that proves you own the coins, tokens, and funds held within your crypto wallet. There are also companies that offer custody in crypto, which makes them responsible for holding and safeguarding their clients' cryptocurrency assets, which may include storing private keys, managing wallets, and providing security measures to prevent unauthorized access or theft. Crypto custody services are typically used by institutional investors, hedge funds, and other large entities that hold significant amounts of cryptocurrency and require a secure and reliable way to store and manage these assets. Crypto lending, on the other hand, involves borrowing and lending cryptocurrency assets for a specified period of time, specifically in exchange for interest payments. Crypto lending platforms allow users to lend out their cryptocurrency assets to other users or borrow cryptocurrency from others with interest rates determined by market demand and supply. Crypto lending is often used by traders and investors who want to generate additional income from their cryptocurrency holdings or gain access to additional funds without selling their cryptocurrency assets. Crypto lending has a big risk versus reward system. There will be a future episode on this particular topic on this podcast. Question 3. How do shitcoins and altcoins get their market cap? I'm considering this as the listener is asking a straightforward question just pertaining to market cap and not how they get their actual value, which we discussed in a previous episode. Market cap means the total value of all the coins that have been mined, which is a bit different than a stock market cap. The market cap of a cryptocurrency, including shitcoins and altcoins, is calculated by multiplying the current price of the cryptocurrency by the total number of coins or tokens in circulation. For example, if an altcoin has a current price of 1 cent and there are 1 billion coins in circulation, its market cap would be $10 million, or 1 cent times 1 billion. It is important to note that market cap is just one metric used to evaluate the value and potential of a cryptocurrency. Other factors such as the technology behind the cryptocurrency, the development team, the adoption rate, and the overall market sentiment can also play a role in determining the value of a cryptocurrency. Question 4. What is Nostr? According to many in the crypto world, Nostr, N-O-S-T-R, is a very simple messaging protocol, and it's important that it is a simple protocol because this allows it to scale really well as it grows in size. There is also no blockchain to this protocol, which many consider creates a true form of decentralization. Nostr, which stands for Notes and Other Stuff Transmitted by Relays, doesn't rely on a central server, nor is it a peer-to-peer architecture. In its most fundamental form, it allows people to exchange signed messages. It does so through a network of relays, which are servers anyone can sign up to run. Many believe this could be the next social media platform, but that's not the real reason it was created. The idea behind it is to create a decentralized social protocol that is independent of apps built on it. The creator wants it to be censor resistant, where it doesn't conform to the host's rules and ideologies. Also, they designed it to where each person's identity would be independent of apps so that it's interportable. Meaning, if someone wants to leave a social media platform like Twitter and wants to switch to Facebook, then they should be able to do it in an instant, without starting from a blank profile or losing their network. Just like how you can email anyone even if they're on Gmail, Outlook, or Yahoo. Nostr is still a work in progress, and many have said it's a bit crazy and difficult trying to get set up with it. For the most part, the biggest thing to take away from this is it is a true decentralized social network protocol aimed at resolving the issues faced by existing centralized social media platforms. On that note, I want to be extremely upfront that I try my best to leave all of my opinions out of this. I know this is very condensed and simplified, but I want you to gain your own understanding and beliefs and not be persuaded by me. I hope this episode was insightful and helpful. If you have questions you would like to ask about anything pertaining to crypto, please either DM the show via the Instagram or Facebook profiles, use the email address provided in the show notes with your question, or connect with us on our Discord group. Remember to share, follow, and subscribe to our mailing list and your favorite podcast app for future episodes so you can gain more with your crypto knowledge. Thanks for listening, and see you next time. Thanks for listening to this episode of the Crypto 101 Show. If you would like to join our email list, email us at thecrypto101show@gmail.com. For more helpful tips, subscribe in your favorite podcast app and leave a review so that you don't miss our next episode. See you next time.